Hi guys, this is CA into Financial Management newly added series, and this is Management of Working Capital. In this two newly added question in illustration 12 and in practical problem 14. Let's get started. This is illustration 12. A traders whose sales are in the region of 6 lakh per annum and average collection period of 30 days wants to pursue a more liberal policy to improve sales. A study made by the management consultant reveals the following information. Credit policy, there are 4 credit policy A, B, C, D. An increase in collection periods to 10, 20, 30, 45 days. An increase in sales 30,000, 48,000, 75,000, 90,000. Present default anticipation 1.5%, 2%, 3% and 4%. The selling price per unit is 3. Average cost per unit is 2.25. Variable cost per unit is 2. And current bad debt loss is 1%. And required return on additional investment is 20%. Assume 360 days in a year. Analyzed which of the above would you recommend for the adoption? Let's get started with the answer. I just wrote down the given data here, and present default anticipation is nothing but bad debt losses. And let's get started with the answer. Let's prepare a table like particulars, and for normally it is 30 days. When it increased to 10 days it will be 40 days, and 30 when increased to 20, 50, like that we have to do it for all. There are 4 different alternatives, A, B, C and D. These are the collection periods, and let's start by calculating the sales. For that, first we have to calculate the number of units sold. So we just do sales is 6 lakh rupees actually, and they have given 3 per unit. When we divide this, we will get per unit. Sales is 6 lakh and sales per unit is 3. So total number of units comes to 2 lakh, which is nothing but 2 lakh units. And then sales is 6 lakh, and in the second case the sales is increased to 30,000. when we add 6 lakh plus 30,000, which comes to 6 lakh 30,000. Same way for plan PCD. Actually I did wrong here. This is current sales, and here A, B, C and D. Days also will be changed. I just messed up with it, so just preparing from the first. And 6 lakh when we add 30,000 in project A, policy A, which comes to 6 lakh 30,000. And same we have to add 6 lakh for all the 3 cases. So 6 lakh 48,000, 6 lakh 75,000 and 6 lakh 90,000. Sales, then we have to minus variable cost. They given variable cost per unit is 2 rupees, which nothing but we found out the units as 2 lakhs. 2 lakhs into 2 rupees comes to 4 lakhs actually. So 4 lakhs. For 6 lakh 30,000 sales, we have to calculate number of units and we have to multiply it. So 6 lakh 30,000 divided by selling price per unit, which is 3 rupees, is 2 lakh 10,000 units, and we have to multiply 2 lakh 10,000 units into the variable cost per unit, which is 2, which comes to 4 lakh 20,000. We have to do the same for all the 4 cases. I just did it. And next they have given average cost and variable cost per unit. So average cost, which nothing but total cost, is 2.25 and variable cost is 2, so the balance would be fixed cost, which is 2.25 minus 2, which is 0.25 of existing units, which is 2 lakhs. When we multiply 2 lakhs into 0.25, we get 50,000, which is nothing but fixed cost. Fixed cost remains same in all the cases, so we have to deduct fixed cost, which is 50,000, we just found out. And if we minus, we will get the profit. 6 lakh minus 4 lakh minus 50,000, which comes to 1,50,000. So we have to calculate the same way for all the cases. After this, we have to minus bad debts, which is 1% in current case. So 1% of 6 lakh, which comes to 6,000. Same we have to do it for here. They have given present default anticipation, which is nothing but bad debt. 1.5% for policy A, which is 6,30,000 into 1.5% comes to 9,450. So do the same for all the cases. When we minus this, we will get the expected profit. When we minus 1,50,000 minus 6,000, which comes to 1,44,000. Same way we have to do for all the policies, and we just found out the profit. And we have to calculate now the opportunity cost, with nothing but they have given here the return on additional investment comes to 20% of the project. The cost, fixed cost and variable cost, which we incurred here is 4 lakh plus 50,000, which is 4,50,000, which we invest in some other project, we will get a return of 20%. So 4,50,000 into 20% for how many days we are getting invested here is 30 days. 30 days divided by, they have given assume as 360 days, so 30 by 360, which comes to 4,50,000 into 20% into 30 by 360, which is 7,500. When we minus 7,500 minus 1,44,000, which comes to 1,36,500. In the same way we have to do it for all the policies. Let's do for second. 4,20,000 plus 50,000, which will comes to 4,70,000, and which was 20% return for 40 days, which comes to 4,70,000 into 20% into 40 by 360, which comes to 10,444. When we minus 10,444 in the profit, which comes to 1,50,550 minus 10,44,000, which comes to 1,40,106. Same way we have to do for all the cases. I just did all the calculation in calculator, but in exam you have to do separate working note for that. It contains marks. So upon this, credit policy A would be better because it provides more profits. So net benefits we arise is 1,40,106, which is higher than the all other policies. So it's better to choose policy A. That's it guys, see you in the next video.